Renewable power. Is it the way of the future? It certainly could be, and for many investors, we're not only looking to make a great financial return, but we're also looking for companies that we believe in, and Atlantica Sustainable Infrastructure might be one of those companies. We can certainly see from this main webpage that they're committed to both climate change improvements, sustainable infrastructure, and they have a very strong ESG focus. So we're going to get into this company, we're going to understand a bit more about them, and stay tuned and stick around till the end of the company, and we'll discuss the fair value for the company then. First, let's look at the great stuff, and for that we'll turn to their own investor presentations. So look, they have indeed a very strong renewable sector portfolio here, so 70% renewables, but there's still 15% efficient natural gas and heating, as well as a diversification here into 12% transmission lines and a very small water element. Geography, so yes, it's predominantly North America, but you also get exposure through to Europe and South America also. What does that mean? Well, it means that a lot of it has been denominated into USD, the United States dollars, and also there's a lot of hedging that goes on. Now, furthermore, they're also somewhat insulated against rising interest rates that we're seeing in the current environment. So 93% of their interest rates and debt project financing has been at fixed rates, so not so impacted by the current rising rates environment, which is always good to see. Now, they're continuing to expand their activities. So here, for example, looking at Chile, they've got the first investment here into photovoltaic cells and a big battery. So a large PV plant plus batteries, and they're believing that this is also at a very, very good investment rate here also. They see the Inflation Reduction Act in the USA as a large growth opportunity, and so they're beginning to develop a large battery storage system in California, and also a pipeline also, so 6 projects here in the southwest of the USA as well. Now you add all this together, so they have been busy with their growth, both in storage, those battery systems, solar PV farms, as well as others. So they're also continuing to expand their existing transmission line business, adding to the diversification of the company. So here we can see the performance both by sector as well as geographic region. So North America revenue and EBITDA is increasing, as it is for South America, with Europe and the European operations here decreasing somewhat instead. Generally, renewable sector increased EBITDA, decreased revenue, and some decreases here in both revenue and EBITDA for efficient natural gas and heat. Transmission lines holding steady, I think, with the small increases there in the very negligible part of their business, the water business. So this is the first 9 months of 2022. We're still waiting for the final quarter update. But revenue is down somewhat. They notice here, if we exclude the foreign exchange and non-recurring project, so we sort of normalize your revenue, they would say it has increased by about 5%, and comparably similar with the adjusted EBITDA. If we exclude all those sort of issues there, they would say, hey, look, EBITDA's increased by about 4%. The reality is, on the books, as we see it as investors, it has decreased. But they're saying, hey, look, their business is growing and their profitability is growing. Now, the cash available for distribution, so as a shareholder, this is quite important. That's increased by about, distributions to us as shareholders. That's increased by about 6% over the 9 months. And per share level, this has increased by 3%. So good to see as an investor. Now, they do have a reasonably healthy balance sheet, they claim, with strong liquidity, about $106 million in corporate cash. They do have the revolving credit facility boosting their actual liquidity here to about $500 million. And one thing I do enjoy seeing here is we're in 2023, and their debt maturity schedule looks quite healthy, with the first, I think, big debt repayment coming due in 2026. But even here, they should have no problem, I think, repaying that at present. So here we are on the ticker terminal. I do enjoy the data-driven approach here and their accurate numbers. So if we're looking at what's happening here, we're up to the 2022 year, more or less. We can see revenue has been relatively stable up until 2022, with a bit of an increase into 2023 and some small increases here into the future. But that's not the only thing we want to think about as an investor. If we look at their debt, they do have large debt. They've been working on paying that down, and they've stated their intention to continue to pay this down. And so we can see the analyst expectations here in 2023, 2024 for the debt to reach a more manageable level. And what that means here is when we're looking at the ratio of debt to EBITDA, we should be seeing this come down here from 2022. From about 6 times debt to EBITDA down to about 5 times, which is a healthier, I think, and much more manageable level for them. Now, as an investor as well, we're often interested in the dividend. So they've been doing reasonably steady dividend increases in the last couple of years. So 2020, dividend per share increase of just under 4%, 2021 just under 4%, 2022 2%, and then analyst expectations are 2023 4%, 2024 just under 5%, 2025 just under 3%, and 2026 just under 6%. So some healthy changes and increases there for the investors. So what is not great? What is not that attractive here? Well, if we consider that the renewable energy market size is expected to grow quite substantially over the next sort of 7 years till the end of the decade, we have here an estimate of a compounded annual growth rate of about 8.5%. One of the big questions is, why is Atlantica Sustainability not able to capture more of that and grow at a faster rate, given their very strong focus on sustainable infrastructure? We can also see back on the ticker terminal that in terms of their total assets have been holding relatively steady but decreasing down to 2021. But we can also see that they've got relatively high intangibles on their books as well, compared to the total assets. And that always concerns me a little bit, although with the infrastructure-based companies, a lot of this is due down to how they run their numbers. It is of some concern. Now, they've been doing some things well. We can see here that, as we already knew, they've got a very strong renewable energy focus in terms of the sectors. The revenue from this has been tracking reasonably steadily until about 2020, with a substantial jump here into 2021. But again, I'm just coming back to this idea of strong growth and strong demand for renewables, and my big question is, why are they expected to only grow revenue here at about 8%, 1%, 2%, or even 7% in 2026? Given the strong growth and demand for renewables, Atlantica Sustainability should be able to do better than what we can see is forecast. Okay, so we are back on fast growth, trying to get a sense of what our investment returns may be in Atlantica Sustainability. So they have a credit rating of BB plus from S&P. We've sort of seen that they have some challenges here with the debt to capital ratio. That's also reflected here in terms of their large debt. So the debt to capital ratio of about 72%. We can sort of see as well, though, from the revisions here for the I've got the set to price to operating cash flow as a reasonable way of valuing and looking at the returns for the company. We can see that the estimates here for the operating cash flow have been fairly steady. There's been a little bit of a downwards revision by the analysts over the last 6 months as they estimate out, say, to 2025. The company is normally traded at about 6.5 times in a price to operating cash flow ratio. Now, if we look here then at the potential returns to the end of 2025, we're talking about potentially a total rate of return of 50%, or an annualized rate of return of only 15%. So that would be, quote, market beating, most likely. A big part of this will be the dividend yield, and as we can see, there's an expectation that the dividends will increase, but not at a very high or strong pace. Now look, if this is useful to you, please do hit the subscribe button, hit the like button, and let me know what you think about this company in the comments below, and stick with me as we learn to invest wisely together. So overall, what do the analysts think of a target stock price? So here we have the mean target stock price by analysts, and we can see since about 2021, as we begin to get a sense of strong inflation, that their mean target stock price has been decreased from about $46 a share down to today about $32 a share. So overall then, what do analysts think of this company? We can see here that the total number of analysts recommending this as a buy is relatively low, so it stayed fairly constant at about one analyst. Outperformed again, one or two analysts, and more recently a lot of analysts have come here with a very strong recommendation to hold this, not necessarily entering and creating strong positions in the stock. So when we begin to think about what the fair value might be, it's currently trading at about $26.86. Analyst targets, as we noted, have it pinned at about $32 as a target price. If we look at a range of different models, they would suggest that about a $34 target price is right. So roughly similar to the analyst target prices. The different models have a very, very wide range here, which is reasonably predictable for this type of company. But this target price here from the financial models would suggest an upside of about 26%. And even here with the analysts' target low price of being about $29 a share, it still represents an upside here. And you can couple that with the reasonable dividend that they do pay out. And look, if you're looking for a hold, this is possibly a good hold. Back to fast graphs, remember they do have that dividend yield of about 6.5%. Yes, we expect that to grow relatively slowly, so it's a good sort of near-term income play with some small dividend gains in the near future. Another way of sort of saying what we might expect the target price to be would be to look at this normalized price to operating cash flow ratio with an expectation here of about $29.60, so comparable to the low end of the analyst expectations. And if prices were to return to this level, again, you could be looking at a sort of a 15% gain over the next year. So we could say that these shares are about 15% undervalued, maybe up to sort of 20 or 25% undervalued. So I think there is a margin of safety here. It's a company, their business model is not going away. They're providing, important renewables infrastructure as well as transmission lines, all of which is here to stay. So there's a huge amount of stability there. I'm very disappointed actually at the small expected rates of gain in terms of the revenue. I think they're spending a lot of their time paying off debt, which is, I guess, good to see on one hand. But I would like to see a greater focus on, growing revenue for this company as well to make it a sort of a strong buy. And I think we're sort of seeing that with those analyst expectations coming through as well. So hit me up in the comments down below. What do you think of this company? Is this a good utility company to add to your portfolio? Does it give you some diversification? Let me know what you think and how it might fit your investment goals and objectives. Stick around with me, hit the subscribe button, hit that like button, and we will see you in the next video.